Welcome to the Stock Guy Analysis. So, the crypto market just got absolutely hammered, right? Prices are down, fear is way up. But what if I told you one of the top strategists out there is claiming that this painful shock is actually this secret ingredient, the setup for a massive rally into 2026? It sounds kind of crazy. I know it's a bold, counterintuitive idea, and we're about to unpack exactly why he might be onto something big. I mean, this is really the core puzzle we're trying to solve. We just watched a historic liquidation event, bigger than the FTX collapse, even bigger than the CO panic sell-off. And the argument is that this massive washout, this moment of, maximum pain is actually a bullish sign. How in the world is that possible? All right, to get to the bottom of this, we're going to break it down. We got 5 key parts. First, we'll look at the shock itself. Then, we'll talk about liquidity, which is crucial. After that, the huge leverage reset, what market history actually tells us. And finally, the new institutional players who are frankly changing the entire game. Okay, first up, let's set the stage here. The recent weakness in the market didn't just come out of nowhere. It was really a perfect storm of 3 major headwinds that hit all at once, creating this cascade of problems and putting some serious pressure on riskier assets like crypto. So, first you had the threat of a U.S. government shutdown. Now, this kind of political drama, it makes investors really nervous. They tend to pull back from anything they see as risky. And with all that capital just sitting on the sidelines, frozen, assets like crypto are usually the first ones to feel that chill. Then, on top of that, the Federal Reserve sent some really confusing signals. They gave us what's known as a hawkish cut, which is a fancy way of saying their actions didn't really match their cautious words. It's like someone telling you everything's fine, but their voice is shaking. That kind of mixed message just added to the anxiety instead of calming things down. And the third piece of this puzzle was the Treasury. They started rapidly building up cash in their main account. Now, you can basically think of this like a giant vacuum cleaner sucking money out of the financial system. That action drained liquidity. And as you're about to see, Bitcoin is incredibly sensitive to that. So, those are the problems that caused the shock. But here's where the whole argument flips on its head and gets really interesting. According to analyst Tom Lee, the key to Bitcoin's next big move is liquidity. And guess what? All 3 of those headwinds are about to turn into tailwinds. Just a super quick refresher on liquidity. It's basically the amount of cash sloshing around in the system. When liquidity is high, money flows easily into assets like Bitcoin. When it dries up, prices tend to fall. And here's the thing. Bitcoin reacts to shifts in liquidity faster than almost any other asset on the planet. And this is the key takeaway right here. All 3 of those pressures were temporary. So once those shutdown fears go away, that capital on the sidelines gets unlocked. When the Treasury starts spending all that cash it built up, it injects liquidity right back into the system. And when the Fed's message finally gets clearer, that appetite for risk comes roaring back. The very things that caused the drop are set to reverse course. Okay, so this brings us to the main event, that massive market reset we saw on October 10th. It was so big, so violent that most people completely missed the real signal that was hidden inside all of that chaos and noise. And let's be super clear here. We're talking about a true monster wave. The liquidations on that one day were the single largest deleveraging event in the entire history of crypto. It was a complete, violent washouts of all the risky bets and speculation. Now, to really put this into perspective, think about this. The amount of leverage that got flushed out of the system on that single day was larger than the entire unwinding during the FTX collapse. And it was even bigger than the market panic we saw at the start of the COVID pandemic. The system just took a punch of unprecedented scale. And here we go. This is the absolute core of the entire argument despite taking the biggest punch in its history. The system held. It didn't break. There were no major collapses, no bank failures, no contagion spreading everywhere. So in this case, what didn't happen is the most bullish signal of all. The absence of a wider crisis proves this market is more resilient than anyone thought. Okay, so if the system itself is sound, what about the price? Let's zoom out for a minute And look at why all these fears of a prolonged crash might be totally overblown by looking at nearly 100 years of market data. Now, this isn't about gut feelings or some kind of crypto-specific hype. This part of the argument is based on cold, hard data from the stock market going all the way back to 1928. It's looking at what actually happens after a long winning streak. And you know what? The data is surprisingly clear. Historically, when a market goes on a winning streak for 6 months or more, the next month is almost never a crash. Actually, the average gain is another 3%, and the worst case ever recorded was just a flat month. The big takeaway is that strength tends to lead to more strength. So, what this really tells us is that markets need to breathe. They don't just go up in a straight line. These little wobbles are completely normal after a big run-up. They only become truly dangerous when there's real structural weakness underneath. You know, things like stress in the credit markets or rising unemployment. And right now, those major red flags, they just aren't flashing. And finally, let's talk about the game changer, the new powerful force that makes this crypto cycle completely different from every single one that came before it, the institutional buyer. See, every cycle before this was all about retail hype. This time is different. Now you have this steady, persistent flow of capital from major institutions. You can see it in the daily inflows to the Bitcoin ETFs, which keep coming even when the price is down. You see it in the commitment from giants like BlackRock and Fidelity. And we're even seeing the early stages of tokenizing real-world assets on platforms like Ethereum. And this creates a whole new dynamic for the market. This institutional money isn't easily scared by short-term ups and downs. They're not panic selling on a bad day. They're using those dips as buying opportunities. This creates a powerful, consistent demand for Bitcoin, building a foundation for the market that is just far more resilient than it has ever been before. So to bring this all together, it really comes down to two different perspectives. The emotional, fearful view sees the recent volatility, the massive deleveraging event, and it just assumes the worst is coming. But the data-driven view, it shows a system that withstood extreme stress, stable credit markets, and a whole new class of buyer that is just steadily accumulating, which really leaves us with one final big thought. History shows us that a market that can absorb a massive punch and not break, well, that's often the market that's getting ready to make its next powerful move. So, the question is all the chaos we just witnessed actually the quiet construction of the foundation for a 2026 rally? The data seems to suggest it just might be. Thanks for watching.